Robert, give me a feel for the market here. I mean, you could imagine people who follow the 10-year yield, see it plunging, think what a great time to refinance. But it's not always just about that. It is about conditions in the mortgage bond market as well. Are refinancing rates following sort of our broader retreat in yields?
Yes, they are. In fact, you mentioned that refinancing is down just a little bit week over week, but it's 167% higher than at this point last year, so more than 2.5 times. So rates are down about 1.25 percentage points from their high in November of last year, and that can translate to about $2,200 a year in savings on a $250,000 mortgage. So it's quite significant.
It is. Are we seeing what you might expect then, given that that potential savings? Are we seeing as the volume of refinancings one might anticipate, given that?
Yes, we are. Our members at the Mortgage Bankers Association report that their volumes are at all-time highs in some cases, and lots of people are taking advantage of these rates. So it is a real opportunity to look at your mortgage, especially if you took it out in 2017 or 2018, because the rates were low in 2016, but they're now lower than they've been since 2016.
So it's a good sign for activity that refinancings are up so much, but mortgage applications to buy a new home fell 4% last week and are only up 2% from a year ago. Why isn't that filtering through into people wanting to take advantage of low rates to buy?
That's a great question, because with rates so low, we would expect to see purchase applications increase more. They're up at single digit year over year, say 5% year over year. But there is still a supply constraint. There are not enough homes for sale, both new homes and existing homes, to meet the demand. And it's especially difficult for first-time home buyers, where prices have gone up more quickly than they have in the broader market. So we're seeing a supply issue and, of course, some of the uncertainty over volatility in the market as well. But given these low interest rates, we would expect to see the purchase applications increase more as well.
Robert, we're watching 10-year Treasury yield get down toward record lows, down below 1.5%. Does the sensitivity of mortgage rates to Treasury yields change much at these very low levels? In other words, let's say Treasuries would continue to go down toward 1%. Would it bring mortgage rates down in equivalent degree, or is there going to be some kind of stickiness there?
Generally speaking, they would come down pretty much in lockstep. And you're right to point to the 10-year Treasury as opposed to a figure that a lot of people look at, which is what is the Fed doing with short-term rates, which, of course, do not drive mortgages because it's a long-term product. So the 10-year Treasury is still a reliable indicator, and if it does keep dropping, mortgage rates will follow suit.
What about home prices? What's the relationship there between how long it takes for rates to impact the overall price of homes, which in June, I guess, rose 3.1% annually, but clearly there's a lag there.
Yes, I was just going to quote that 3.1% figure because it's actually a healthy thing that home price growth has slowed to a point where it's about equal to what wage growth has been, and that's a good sustainable level. If it's rising much faster than wages, then it's unsustainable and can set ourselves up for a fall. But seeing these home prices moderate to the 3% range is a good sign for the market.